Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're discussing a common question we receive on withdrawing from a 401k to pay off debt, specifically credit card debt, and the real impact of this decision on your current and future financial situation.
Yeah, stats are showing more and more people are pulling out their 401ks right now.
Yeah.
And the decision on whether or not to withdraw to pay off debt isn't as cut and dry as people think.
No, it's not.
There's various factors you need to take into consideration. Otherwise, you could end up losing 30% of your money to early withdrawal penalties.
And that's a rude awakening when you think you're pulling out 10,000, but you find out you only get 7.
Yeah, it is. And it happens all the time, Michelle.
All right, well, let's get to it then. What do people looking to pull from their 401k to pay down debt need to know so they don't financially screw themselves?
I got 3 key points you need to keep in mind. A real quick caveat before I get into it, though. Remember, each of us has unique situations, and the decision depends on various factors. So what works for one person may not be suitable for another.
Okay, good to know.
So the first thing to keep in mind are penalties and the taxes. Withdrawing funds from your 401k before reaching the age of 59 and a half may be subject to IRS early withdrawal penalties of up to 10%. Also, the withdrawal amount is typically considered taxable income, which means you'll owe taxes on it. And the IRS requires automatic withholding of 20% of a 401k early withdrawal for taxes. So if you withdraw $20,000 from your 401k, you may only get $16,000 after taxes are taken out. And the amount withdrawn may be taxed as ordinary income for the year the money was taken out, which could push you into a higher income tax bracket, and you'll be forced to pay even more taxes. I'm going to show you an example of this in a bit. I want to get through these 3 points first, so make sure to watch to the end.
All right, well, let's move on then. What's the second point?
You need to keep in mind debt interest rates before you withdraw from your 401k. Make sure the math adds up, so to speak. Compare the interest rates on your debt to the potential investment returns inside your 401k. If the interest rates on your debt are high, it might seem tempting to withdraw from your retirement savings to pay them off, especially right now after we had a down market, right?
Sure.
However, if your 401k has been performing well and generating higher returns than what your debt interest rates are, it might be more beneficial to keep the funds invested and continue making regular debt payments. The third thing to keep in mind is the long-term impact of your decision.
Yeah.
Your 401k is designed to provide for your retirement, and withdrawing funds early can cut your long-term savings and your potential growth. The money you withdraw loses out on compounding interest and potential market gains over time. The question you need to ask is, can a withdrawal get me ahead quicker and back to saving long-term?
So people should start with that question and then make a list of pros and cons based off the 3 points that you just went through.
Exactly.
So you said you were going to give us an example to let this play out for us. I want to get to that now.
Okay. Let's say you're 45. You make $45,000 a year and you want to withdraw $20,000 from your 401k, which is averaging about a 6% per year return, to pay off some credit card debt of $20,000, which you're paying 29% interest.
Ouch.
Yes. So to compare the cost of withdrawing $20,000 from your 401k to pay off your credit card debt versus keeping the debt and paying the interest, we're going to calculate the fees, the penalties, the taxes, and compare it to the cost of your credit card interest.
Okay.
As you're 45 years old, withdrawing from your 401k would incur an early withdrawal penalty of 10% on the $20,000, which is $2,000. Okay. Since the amount withdrawn is considered taxable income, you're going to owe taxes on it. The tax rate depends on your income tax level and your tax bracket. For example, let's assume a 12% tax rate, okay, based on the 2023 IRS tax schedule. So the income tax on that $20,000 withdrawn would be $2,400.
Okay.
Therefore, the total fees, penalties, and taxes on the withdrawal would be $2,000 for the penalty and $2,400 for the tax, for a grand total of $4,400. Now, let's look at the cost of your credit card debt.
With that interest rate of 29%.
Yes, $20,000 at 29%. And yes, I've seen this. And actually, Michelle, I've seen actually a lot higher than this, depending on the person. So Let's calculate the cost of the credit card debt. We need to determine the interest rate paid over a specific time. Let's say you wanted to accelerate paying off this debt over the next 3 years, which is 36 months.
Okay.
We're going to use a loan calculator. The total interest paid on this $20,000 at 29% over 36 months would be approximately $10,172. And we put a link to this calculator that we use. So go in there and play with this calculator.
Yeah, it's in the description below.
Exactly. Therefore, the cost of the credit card interest over the repayment period, $10,172. Compare it to the cost of the 401k withdrawal with the fees and everything of $4,400. Based on this comparison, Michelle, paying off your credit card using the 401k withdrawal would result in lower cost and fees, penalties, and taxes. Please note, this is a simplified comparison and doesn't consider other factors like potential future growth of your 401k or changes in the interest rates. Also, the big aha moment is, what will you do now with the credit card debt you just paid off?
Yeah.
Is it just charge the credit cards back up? This cycle will never end and your future retirement will suffer.
Absolutely. I have known a few people who have withdrawn from not 401k, but an IRA and racked credit card debt right back up.
Yeah.
Because that's another thing I think too, you take into consideration. It sounds good, you're going to pay it off, but if you have a poor track record of racking things back up, then maybe this isn't something you want to do.
Or an emergency hits and you have to use it and it's available. And it's like, okay, well, I'll just use that. Well, now you're back into that debt again. So there
you go. All right. So here's the thing. If you like the content of this video, hit the like button, subscribe, and leave us comments. Let us know what you think about this. And if you do the math, we'd love to know it. We've been talking about withdrawals here, but 401k loans are also an option. So we're going to drop a link below this video to one we did on 401k loans and why you need to be aware of double taxation with those. So do go check that out because there are two ways. You can just withdraw the money or you can take out a loan. Go check that out for sure. All right, Brian, before we wrap this up, is there anything else you want to add?
Just be careful in it and calculate the numbers. Use them calculators that we
do the math.
Put in the links below and play with it and figure it out for yourself as far as which is the better option for you. But in the situation I gave, it was a better option to take the withdrawal and take the penalties and the hit against your taxes compared to that 29% credit card debt. So
do the math, do the math, do the math. Again, we'll put that that calculator, credit card payoff calculator below here as well. So
exactly.
All right. Well, thank you to everyone who watched. Make sure you like, subscribe, and comment. Until next video, have a good one.
Have a great day, everyone.